Hi, this is Tom Sherman with Benchmark Mortgage. Hope you're doing great today. A couple things we want to talk about today. We're going to be talking about how to pre-qualify a borrower. One of the questions I get all the time is how can someone get qualified to purchase a home loan? We're going to talk about the four things that are really important when you're qualifying a borrower. The things we're going to talk about today are called the 4 C's. The best way to remember that is the 4 C's. So the first C, of course, is a borrower's credit. So C number 1 is credit. When we're looking at credit, we're making sure that a borrower has a minimum of a 620 FICO score. FHA requires 620 to 640. Now, there are some lenders that will go below a 620, but really, as a consumer, you really want to focus on getting your score above that. Conventional loan really wants to see a 660 or above if possible, and most of your MI companies want to see a 680 or above. So we're really going to focus on credit with the consumer. The second C we're going to look at is the borrower's capacity. And the capacity is the borrower's ability to repay a mortgage loan. What we're looking at on capacity is the borrower's debt-to-income ratio. There's a lot of things that go into a debt-to-income ratio, but primarily what we're looking at is their gross income and their gross monthly fixed debt. So, for instance, things like electricity and water is not considered in calculating capacity. Things like credit cards and car payments are considered in looking at capacity. What we're going to be focusing on is having a debt ratio that does not exceed 41%. So total debt in relation to income cannot exceed 41%. That's qualification ratios. Now, I will tell you, I really like to see a client stay in that 36 to 38% max capacity. The third C we're going to look at is the borrowers. We got credit, we got capacity, and now we're going to have collateral. And when we're looking at borrower's collateral, we're going to look at their appraisal, we're going to look at what the house is worth, and we're going to look at whether or not the borrower is paying too much or too little for a home. We're also going to be making sure that the home is in good quality. So one of the things that's different here in the last couple of years is that we really underwrite an appraisal almost to the same degree that we underwrite a borrower. So when you're looking at a house, you've got foundation issues or you have roof issues, know that that's going to be an issue in getting approved for the loan. Last but not least, we're looking at the 4th C, which is cash. And the 4th C is how much money are you putting into this house? Obviously, putting 20% down is great. Not everybody can do that. So the minimum requirement on an FHA loan is 3.5%. That's 3.5% down. On a VA loan, you can actually put no money down, but you have obviously to be a veteran. And on the USDA loan, assuming you hit the income guidelines, you can put 0 down as well. If you have any questions, please don't hesitate to call me at 214-680-1166 or reach me at email at tom.sherman@benchmark.us. Make it a great day.